Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and we're getting an update today from Troilus Gold Corp, traded on the TSX under the ticker TLG and on the OTCQX under the ticker CHXMF. We're joined today with the president and CEO of Troilus Gold, Justin Reid. And Justin, it's great to get you back on the KE Report. It's been a little while since we've chatted, but we've got a big update today, and it's really today's focus is recapping the feasibility study that you released to the market last week. And this project is a whopper of a project, 22-year open pit project. It's in a tier one jurisdiction. And we can go over the metrics here. But what I want to start with is I got a lot of questions and comments that came in preparation for this about the internal rate of return, the IRR, being 14%. And you had messaged to the market that because this is a long life asset, because it's a 22-year mine life, and it's not an underground mine with a tiny capex, that it's going to be a lower IRR. But you took a lot of heat for it on social media, and I'd love you to unpack the big picture vision here of this is not an 8 or 10-year mine life. This is a long life generational asset. So speak to the IRR first for people that had questions about that.
Sure, and thanks for having me, Shad. And very fair comments. I think when you look at Troilus, like you said, it's not a high-grade underground deposit that you're going to get a screaming IRR on. And maybe we should have done a better job communicating this. However, if we look at low-grade bulk tonnage deposits, first of all, they're the mines that are getting built. They're the mines that are providing scale and scope. And Troilus does exactly that. But with regard to the IRR, it is right at 14%, and that's at long-term prices where we are 450, almost $500 higher than that now. Similar assets, Cote's IRR is 13% before some of the further cost overruns. When Detour came out, they were in the low teens. When Malartic came out, they were in the teens. These type of deposits, because of the capital required early versus the grade and the scale that you go at, you're never going to get a super high IRR. So from that standpoint, Troilus is right down the middle of the fairway with the largest assets producing in North America in a low-grade bulk tonnage scenario. But why are these mines getting built? Because they're providing life of mine, scale, they're providing huge production volume. Troilus, including the ramp and the tail, is over 300,000 ounces equivalent a year. But really, when you dig into it, kind of year 4 to 7, we had peak production at almost 540,000 ounces equivalent a year. So these are massive cash flow generating assets. They don't give you huge IRs because of the initial ramp in capital, but they provide a huge amount of free cash flow. And really, that's what the majors and investors who are looking for yielding products in the future are looking for. So from that standpoint, yeah, not a flashy number, but we can go through the different sensitivities as well. But I would say right down the fairway for this type of asset.
Well, and we were talking off mic before this call that if you think back to just when Malartic was launched, it was a similar thing. It had a lower IRR. People boo-hooed that in the retail community, but over time we've seen it grow into be the largest mine in Canada. And I think it's also important when you have a longer life mine like this, the first couple of years when you're ramping up, you're not at optimization yet. Like you mentioned, by years 3 to let's say 7, you're really starting to ramp up the production profile. And if you had started the IRR process there and looked at the next 10 years after that, it'd be a different scenario. So maybe speak to people about how this ramps up over time and how the economics improve over time.
Well, once capital's sunk and you're moving in, free cash flow generation takes off at base cases. And then in a DCF model, you're really getting no economic value beyond 10 years, quite typically. And we're providing 22 years of potential cash flow. So Troilus, in sub $2,000 models, will generate over 2.2 billion US dollars in free cash flow at spot prices. And when I say spot prices, the analysis we ran was April's average, so $2,300. We're up above $2,400 right now. And I think probably going higher is $3.5 billion US cumulative free cash flow. On an annual basis, at base cases, it's 150 million US in free cash flow. At spot prices, it's 205 to 215, and that's average. When we hit year 3, 4, 5, and 6 at Troilus, that free cash flow at spot prices now will go up well into kind of the $500 million mark US. So huge ability to cover any kind of financial instruments put on place to build this mine and finance. We'll talk about that a little later. But yeah, spot prices, all of a sudden your IRR is almost 20% after tax. And if you keep going and believe in almost $3,000 gold, it's a 30% after tax IRR. We really look at kind of the value today, and at 2,300, this is 1.6 billion US dollars. So huge leverage, but at our base case scenarios, capable of being funded, capable of being built, and we have great examples in this market of success. Detour had a lot of growing pains, but was a huge success. Malartic had growing pains, huge success. You're looking at Greenstone and Cote now, who are, I think IAMGOLD's pouring, Greenstone's going to pour next month, going to be some of the biggest cash flow producers in Canada, if not North America. So incredibly levered. And what this study shows is economic stability and ability to fund and give a return. I would also just add, and I'll throw it back to you, this is the first feasibility of this scale that the market's really seen in the last 4 years. We haven't seen something like this really since Cote. And so we took a very conservative stance, and we have the full brunt of the last 4 years of inflation baked into these numbers. We're very proud of these, and we think the numbers are bulletproof as well. We think they represent a very true indicator of what this mine can be.
Well, and Justin, I do want to dig into some other details, but you raised a point that I think we should just address right now, and that is when you look at the mines that are being built in Canada, to your point, when you look at Malartic, when you look at Cote from IAMGOLD, when you look at Greenstone from Equinox just going into production, these are the big bulk tonnage mines. Detour, that was eventually acquired by Kirkland Lake and then by Agnico Eagle now. These are the future of Canadian mining as far as the big bulk tonnage, and people are not used to looking at large bulk tonnage economic studies because it's been a while, and this is also in the inflation adjusted world. A couple of years ago when those mines were being first platformed, they've had big cost overruns. You've baked all that into the numbers, as you say. So maybe just speak to the reception you've got from institution investors looking at that may differ some from the way retail initially had a knee-jerk reaction to it.
Yeah, we're 70% institutionally owned, mainly from the largest gold funds and resource funds in the world. And so we spend a lot of time communicating with them as we move forward. We've had a solid response from them. We haven't seen institutions exit on our name. In fact, I would say our top 10 has swallowed up all of the retail stock that's come available over the last 2 weeks, which has been great. And we've talked to all of them. A lot of the fund managers and PMs, they went through Detour, they went through Malartic, they went through Magino and Cote and Equinox as well. And they knew exactly what to expect. They knew what the type of returns you get from these. They had a very good idea, and we never minced our words on what the capital was going to be like this in feasibility. Our PEA was 4 years ago, pre-inflation, 12-year open pit going underground. It was a $350 million capex, but we had $400 million in sustaining capital coming in as you expanded underground. I would say to your question, though, yeah, the large fund managers thought this was a very solid study, and they wanted to focus on the cash flow profile. At the end of the day, it was all about what does the free cash flow profile look like, and where's that capital going to go? And how much sustaining capital is going to be reinvested back into the mine as you move forward. And we had very little pushback. In fact, really great discussions on it. All the analysts that cover our name, it was almost unanimous increase in target prices across the street because we now have a reserve, and that is a major mark.
Maybe just speak to the reserve that you have as far as the number of ounces versus the actual number of ounces you have in resources and how there's still upside there too, because really only about half of the ounces are included in this.
Yeah, so and when I say ounces, it's equivalent. And so I may fail to say equivalent every time I mention ounces, but think about 22% copper, 76% plus gold, and a couple percent silver max. 6.7 million ounces equivalent in reserve. We have a 13 million ounce equivalent resource through indicated and inferred. 11.2 million ounces is indicated. And so it's a function of drilling, and you have to put a pin in it sometime. And so we were able to deliver a solid study with incredible production, low cost, and great cash flow generation, which is generational in scale. And so you're going to see, especially on the indicated, those ounces convert back in. As we drill more and continue to explore, this is not going to be a 22-year mine by any means. I think it's very easy to say that this will be 30 years plus at 50,000 tons a day. Whether future expansions can be done or not, remains to be seen. But yeah, this was simply a function of drilling.
Yeah, and I think it just shows how much more upside there is when you start jumping categories in some of those other indicated ounces and inferred ounces and move them into the reserves. It's just going to extend the mine life even longer. Let's talk about grade next. I had a couple questions on this, and I saw a couple comments in the marketplace about the grade dropping by, let's just say, roughly a third from the study a couple of years ago to this study, but then you've increased the throughput. What can you say about the grade or the changes to grade and maybe address those questions?
Sure, I think it's fair comment. First of all, the grade from the PEA was 4 years ago, September of 2020. At that time, I think we only had about 6 million ounces equivalent. We had a 14-year mine life. I think the first 6 to 8 years was open pit, a little more, and then we went underground. And the moment you go underground, we were obviously mining significantly smaller areas. We had raised the cutoff grade, and you were having the inclusion of significantly higher grade via an underground operation. When you move all of that into open pit scenarios, you're going to get a lot more dilution. The grade's going to come down. And so it was really a function. The grade didn't really go down. What happened is the underground just got more diluted or less inclusive. We also drilled an additional 250,000 meters of open pit material. And so that brought the underground down too. So average grade of the mine is 0.59. If you look at the major deposits right now, both Malartic and Detour are running significantly lower grades through the mill. This is well represented in these type of deposits, so we're not worried about the grade profile at all. And in fact, when you look at our biggest production in, call it year 3 to 8, and I'm just looking at graphs in front of me, year 5, 6, 7, we're running 0.8 to a gram through. So it's quite a variable grade, but there are grades of significantly higher grades that come in kind of the first 10 years. Just year 1 and 2, we've got to get through a lot of pre-stripping.
All right, I appreciate you breaking that down, Justin. It makes a lot of sense when you go from the underground scenario to more open pit, and then when you do all that additional drilling and change some of the parameters there, you're going to see that. But you're also going to see, like you say, a longer mine life, but then in years 3 through 8, that grade profile rise and be a bigger contributing factor. So it is variable, and I think people are quick to make a judgment without looking at the whole picture. Let's also talk about the capital stack, the capex to build it, the options you have. Because it's polymetallic, because you have both copper and gold and a little silver, you've got some options on what you can do with the copper, with the silver, in addition to the gold. And that all ties into that gold equivalent. Maybe walk us through some of the options on the table for the capex, because a lot of people are saying, Justin, you'll never get this mine built. It's too expensive. What would you say to those people?
I would say that when I was a banker, I heard the same thing at Detour, and we were able to raise all the money for it. And I heard the exact same thing when at Cisco at Malartic, we had the exact same thing, and we were able to get those funded. So these are the deposits that get built. Exact same thing was said to Greenstone or to Equinox, and that got built. And the exact same thing was said to IAMGOLD. So, and IAMGOLD didn't really have the free cash flow profile to fund it themselves. And we can talk about, the levers there. First of all, in capex, so $1 billion US capex seems like a big nut, but what I would say is that there also needs to be a consideration for the existing infrastructure we have. The power infrastructure, the roads, a lot of the civils are done. Most importantly, the tailings facility, that's the $350 million capital item. In real-time dollars, we are saving, because of the brownfield nature of our deposit, almost 500 million, just under 470 something million US that would have been in the capex should this have been a greenfields development. So, right away, you're kind of at a 1.5, 1.6 billion. Second of all, the fleet, fleet maxes out of 40 trucks and 2 shovels, I think. And, that's a $197 million US item as well. Because of the strong cash flow and the great terms we're getting from CAT, we moved the capital out and we're leasing the fleet. That works out to about $1.90 a ton in our $19 a ton operating cost. But again, this mine is able to handle that very easily. So add that all up together, it's $1.7, $1.8 billion US, which is Cote, which is Greenstone, and which is inflation adjusted Detour, which went through $2 billion. So it's a big capital number for sure. Now, to your point, what levers do we have to help fund this that maybe the standard gold mine doesn't have? And we're a multi-commodity deposit, first of all. We're a copper gold mine with some silver. I don't know exactly what the peak number is, but we're going to average almost 500,000 ounces, just under 500,000 ounces of silver a year. If you use precedent transactions from the market over the last 2 years on royalties and streamings, it could be shown that the silver stream could bring potentially between 80 and $100 million US, which is a huge potential funding lever for something that accounts for just over kind of 1% of the total revenue. So it really doesn't have a lot of impact on the value. We also produce 74,900, so I'll say 75,000 wet metric tons of copper concentrate. This can be the largest copper concentrate producer in Eastern Canada right now that's in the permitting stage. There are some planned for the future that are kind of 4 to 5 years behind us. If everybody's following the copper market, which I think they are, we've knocked on $5. TCs and RCs at the smelters are dropping to all-time lows. There is a massive shortfall of copper con going forward. China is opening a new copper smelter every 8 months, and the copper con is in incredibly high demand. We are getting daily inbounds from traders, smelters, refiners that are looking to source. And when you look at offtakes and prepays, the ability to fund a significant portion of this capex would likely come through working with the smelters and providing supply to the important ones. So that's a lever that we have that most don't have either. And all these levers take away from essentially required equity, which is typically dilution. The other thing to look at is our institutional share base. Significant portion of our company is owned by Investissement Quebec, the CASE, Fonds Solidaire de Quebec, the large Quebec pension funds, which have multiple objectives or mandates within their fund. And there is a very well-documented track record of these pseudo-sovereign institutions providing senior secured debt or a portion of it to strategically important assets in the province, of which Troilus certainly is, maybe not from the gold side, but certainly from the copper side, as we're going to be fairly significant copper producers. So, and then with our institutional base as well, I think our access to capital is there. So on a 100% basis, there is a pathway to complete funding. The risk is there will be an equity component to us, and how do we mitigate that? I'm a very large shareholder myself, and we're all sensitive to dilution. And there's more money to spend to get to break ground as well. When you look at these type of assets, though, what we have seen very well documented, especially in North America, over the last 3 to 4 years, is partnerships, where, and we can talk about a Cisco windfall with Goldfields. We can talk about Equinox with Orion Mine Finance, and Orion's already exited at a good return. Sumitomo and IAMGOLD at Cote. Spreading the risk by bringing in a partner at the asset level provides, Troilus with upfront capital as they buy in. I would say validation of a major or a proven producer from a market standpoint, and ultimately a far lower cost of capital by using the balance sheet of a major. And so I would certainly say that potential partnership is something we're seriously looking at as well. And we've been saying that for a while. So you run both streams at the same time, but Troilus has a whole bunch of levers that I would say the standard gold producer doesn't have.
All right, Justin, I appreciate you breaking down how the capital could come together to fund the overall project. I guess just as we wrap up, as we've covered a lot of information here, from the grade profile, the mine life, the capex, the long generational asset that's probably going to go longer than 22 years, more like 30 plus. You can see that there's a lot of interest in large open pit bulk tonnage mines in Canada, and a lot of the same concerns that came up at each one of those mines when they were built are the same things you faced, when you put the study out last week. What final comments would you have for the market? What's the key takeaways you really want investors to have when they look at this economic study, the feasibility study?
Thanks for that summation. Scale. There are not many assets that have a production profile of over 300,000 ounces a year, which, like I said, can peak up to past 500. For a mine life that is a minimum of 22 years and will extend. We have only really been a company 5 years, and we inherited 1 million ounces, which was really an underground target, and that's what we came to market. So 350,000 meters of drilling in 5 years, definition of 13 million ounces equivalent. And this is feasibility is a moment in time, it's a pin. I think the commodities are going to continue to move aggressively. Troilus is the most levered name. And what we're incredibly confident in is at base case scenarios that this gives you a good return, which will transcend into a great return. We have not even started exploring Troilus. We've been very focused at mine scale at the southern rim of the diorite, which extends over kind of 8 kilometers. We have the whole northern rim to even start exploring, which we believe is going to bring in huge opportunities, and we'll continue to explore. So this is the generational asset. The growing pains that we're going through have been seen and repeated over and over again, and these are the assets that get built. So, certainly very thankful of our supportive shareholders. And, Troilus is never a trade. It's a long-term value proposition. And this was a major de-risking event to the next stage for us. And, I also just want to reiterate, forget about the speculation you see online. Give me a call, and we're always happy to talk to anyone at any time and walk you through all these things personally. And Shad, thanks for your time today.
Well, Justin, it was great having you on the show. I really appreciate you taking a deep dive into the feasibility study at the Troilus Gold and Copper Project. We'll keep following along with the news here at the KE Report. And for people listening, if you want to dig into this news and take a deeper dive, there'll be a link under this interview that takes you directly over to the company website, to their news section. Pull it up and read through it and look at all the details. And if you have a question, send it to me, send it to Justin. We'd be glad to get those answered for you. Justin, thanks for coming on the show, and looking forward to our next conversation.
Thank you for having me, and we'll talk to you soon.